and how you record keep, where you could get to a stage where you would be able to progress into using software like Xero or MyOb or QuickBooks or those type, which is what you're going to want to do. So let's just first get an understanding. So your systematic documentation of financial transactions will include receipts, invoices, any financial records to make sure you ensure accuracy, compliance, and easy business management. So you need to track it. Now, they're actually called source documents. That's the term. Source documents are still essential, but now they're mostly digital. All right. So you have invoices, possibly e-documents or PDFs, receipts, so stored digitally instead of paper copies. You've got your bank statements, which are all accessed through your banking app. Contracts and agreements, we still do have seen them paper-based, but we're moving into signed electronically, DocuSign or Adobe Sign and so forth. And then a lot of the stuff, we're getting into a stage where it's all going to be stored into your accounting software, like, as I said, Xero or MyOb. Alrighty? Now, while physical copies are rare, digital records are crucial for your tax, compliance, your audits, and your financial tracking. Okay? That's essential. Taking a snapshot here, a simple cash book. Now we completed this for our Cert 4 students as an example, but it's old school, but it gets you to have an understanding of cash in and cash out, income and expenses. So a record tracking cash flows for income and outflows are expenses. So your income are, for example, progress payments received. As a builder or a subcontractor of any trade, you will mostly be receiving income from progress payments. Expenses, there will be a larger list of expenses, materials, vehicle costs, subcontractors' payments, tools, and others. Having a look at this snapshot, it just really simplifies it so you can have an understanding of money in and money out. Now, you will highly likely use a software program that will be doing that, but this is like a real good example of how it's set out, old-fashioned style. All right. Now, debits and credits are actually quite complicated, and to actually teach them, I've always sort of mucked up as a builder rather than as like a business coach, but they're the foundation of your double entry accounting, ensuring every transaction affects two accounts, so how they work. So you've got your debits, which increase your assets and expenses, and it decreases your liabilities and income. Your credits increase your liabilities. This is for you, so your business. Increases liabilities, equity, and income, and it decreases your assets and expenses. So let's just have a real simple example. So your business has taken a loan. Now, it's a debit because it's an asset. It's gone into your bank account, which is awesome. But it's a credit, so double entry. It's a liability because it's a loan payable. You have to pay it off. So a key rule, for every debit, there must be an equal credit. So debits and credits in the cash book are the opposite of how they appear on the bank statement. So be careful of that. The bank statement is the bank's money, yeah? So we don't need to go into too much depth, but as long as you have an understanding for debits and credits, have an understanding for your cash book for cash in and cash out, and then having an understanding, you don't need to do it because this is completed in software, a bank reconciliation. So you're matching your records. So it's a process of ensuring your cash book and your bank statements match. Now, this would always happen in the software, but this is just real simple for you to understand how it actually works. So let's just have a look. So steps to reconcile. Let's have a look. So what you do is you open compare your opening balances in your cash book and your bank statement. So that's your cash book on the left where you've been filling it out. And then you've had a look at your bank statement from the bank. So you review all recorded transactions. You adjust for any discrepancies. There could be some figures, at the end of the month that might not have moved over, or you might have made a payment at the end. Make sure you adjust that from the bank statement into your cash book, and then you reconcile it. So really, you're just checking that nothing's missing in its simplest term. There's a couple of terminology here which are a little bit old school, but they're good for those that actually have a crack at doing a bank rate. Outstanding credits, so they are payments received but not yet reflected in the bank statement or within the bank. And unpresented checks, which are, money received or monies issued but not yet cashed. Be mindful, bank fees and errors. You need to adjust for any unexpected charges or incorrect entries. Remember, you do not need to do these anymore. This is sort of old school, but it just gives you an understanding of how you set it up. If I'm going to run my own business, I would be setting up a cash book. I'd start that first, and I'd do it on a spreadsheet, keep it simple. Income and expenses. Yeah, that's all I do. Fill in the details. That's your first journal. Don't worry about double entry because it's too difficult and you're not an expert in that field. You have software to do that, and then you hand it over to your bookkeeper or your accountant. They will look at the bank reconciliation. They'll make sure it all matches. From that, I would recommend to get a good understanding of profit and loss statements and a balance sheet. I'd highly recommend those couple of videos from Xero. You can search them yourselves and find out. There are also a lot of links to help you setting up your business for record keeping. Start small and slowly build. Alrighty? I hope that helps.